Banks are panicking. Not quietly, not privately, publicly in their stock prices for anyone paying attention. This week, something happened in Washington that triggered a sell-off across some of the most powerful financial institutions on Earth. And the reason why, the real reason, is being completely buried by the mainstream financial media. By the end of this video, you will know exactly what that reason is, and you will understand why the assets sitting in your crypto portfolio right now may be the most consequential financial position you've ever held. Stay with me, because this one connects everything. Let me give you a number first. In the 48 hours following the Clarity Act's advancement in Congress, combined market cap losses across major U.S. banking stocks hit billions of dollars. JP Morgan, Bank of America, Citigroup, Wells Fargo. These are not struggling companies. These are the most well-capitalized financial institutions in human history. So why did their stocks drop? The financial press gave you three answers: rate concerns, macro uncertainty, profit taking. All of them wrong. The real answer is sitting in a 400-page piece of legislation that almost nobody outside of institutional finance has actually read. And what that legislation says, what it actually does when you strip away the legal language, is the most disruptive thing the U.S. government has done to the banking system since the Federal Reserve Act of 1913. I'm not being dramatic, I'm being precise. Here's why. For over a century, banks have controlled one thing above everything else: the pipes. Not the money itself, the pipes the money flows through. Every time you send a wire transfer, every time a corporation moves capital across borders, every time an institution settles a trade, that value has to travel through a network of correspondent banks, clearinghouses, and settlement rails. And every single stop on that journey has a toll. SWIFT fees, ACH processing fees, foreign exchange spreads, intermediary bank charges, settlement delays that banks turn into overnight float revenue. Most people never see these fees directly. They're buried in the spread, absorbed into the transaction, hidden in the fine print of your business account agreement. But they are enormous. JP Morgan alone generated over $9 billion in payment processing revenue last year. Bank of America, Citigroup, Wells Fargo, all pulling billions from these same pipes every single year. Now here's the question I want you to sit with for a second. What happens to that revenue, those billions, if the pipes change? What happens if a new payment infrastructure emerges that is faster, settles in 3 to 5 seconds instead of 3 to 5 days, costs fractions of a cent per transaction, and here's the part that keeps bank executives up at night: doesn't need the banks at all? That's not a hypothetical. That technology already exists. It's called XRP. And the Clarity Act just made it federally legal to use it at institutional scale. Here's where I need you to pay close attention, because this is the part the financial press is completely glossing over. Most coverage of the Clarity Act focuses on the securities versus commodities question: which assets fall under SEC jurisdiction, which fall under the CFTC. That's important, and we'll get to it, but it's not the disruptive part. The disruptive part is this. The Clarity Act creates a legal framework for digital asset payment rails to operate at institutional scale outside the traditional banking system. Let me break that down into plain language. Stablecoin issuers can now hold reserves and settle transactions without being chartered banks. Crypto payment networks can process cross-border value transfer without touching SWIFT. Institutions, hedge funds, asset managers, corporations can move billions in tokenized assets without a single correspondent bank in the chain. For the first time in modern financial history, the US government just officially said, you don't need the banks to move money. Read that again. You do not need the banks to move money. Now do you understand why bank stocks dropped? This is not a regulatory technicality. This is the government officially unlocking a door that banks have been fighting through lobbying, through litigation, through regulatory capture to keep closed for 15 years. And behind that door is the entire digital asset payment ecosystem, with XRP sitting at the center of it. But here's what most people still haven't connected, and this is where it gets really important. Stay with me. Before I show you the institutional playbook that's already in motion, and I mean the specific accumulation patterns that are happening right now, on chain, in real time, make sure you're subscribed. Hit that button, because what I cover in the next section is why the smart money positioned months before the Clarity Act ever made headlines. And if you're not subscribed, you're going to miss the follow-up video that shows you exactly what comes next. Now let's connect the Clarity Act to what we've been tracking on this channel for months. In March 2026, the SEC and CFTC issued a joint ruling that declared 16 specific digital assets as digital commodities. Not securities, commodities. XRP, Ethereum, Polkadot, Algorand, and 12 others. That distinction is not semantic, it is operational. As commodities, these assets can now be used as the base layer of payment networks, settling real transactions, real institutional transfers, without triggering securities law violations every single time value moves. Pre-Clarity, a bank or fintech that wanted to use XRP to settle a cross-border payment was walking into a legal minefield. Every transaction was a potential securities violation. Every settlement was a compliance risk. Post-Clarity, green light. And XRP wasn't just the first asset to get that green light. It was engineered for this moment. 3 to 5 second settlement finality. Fractions of a cent per transaction. Institutional grade custody infrastructure already in place. A network with over 50 financial institution partnerships already built. XRP was designed to do exactly what SWIFT does, but faster, cheaper, and without the toll booth at every stop. Now the legal framework has finally caught up with the technology. And here's what makes this extraordinary for investors. The 7-spot XRP ETF applications currently sitting in front of the SEC from the largest asset managers on earth are not just investment products. They are Wall Street building the on-ramps to a payment asset they now need to hold. Because if XRP becomes the settlement layer of institutional payment rails, and the Clarity Act just made that pathway federally legal, then every institution that facilitates those payments will need XRP liquidity on their books. The demand equation just changed, fundamentally, permanently. Now, I want to zoom out for a second. Because the Clarity Act's impact isn't limited to XRP. BlackRock just filed for a staked Ethereum ETF, and the timing is not a coincidence. Ethereum is the programmable value layer of the Clean 16 ecosystem. Where XRP handles settlement, Ethereum handles the smart contract infrastructure, the logic that governs how institutional assets move, how tokenized securities settle, how DeFi connects to traditional finance. BlackRock filed that application knowing exactly where the regulatory wind was blowing. They saw the Clarity Act coming, they saw the Clean 16 ruling, and they moved. That is what institutional positioning looks like. They don't react to headlines, they position in front of them. And here's the through line that ties all of this together. XRP is the payment layer. ETH is the programmable layer. Bitcoin is the reserve asset. The Clarity Act didn't just clarify the rules for these assets. The Clarity Act didn't just clarify the rules for these assets. It created the legal architecture for an entirely new financial system. One where banks are optional, not mandatory. That is what the bank stocks are pricing in right now. Not a temporary disruption, a structural, permanent erosion of their most profitable revenue stream. Here's what smart money does when a structural shift like this becomes legally confirmed. They don't react. They don't wait for the news cycle. They position months in advance and then let the narrative catch up to their trade. On-chain data tells the story clearly. XRP wallets holding between 1 million and 10 million tokens have been in steady accumulation since Q4 of 2025. These are not retail wallets. The transaction patterns, the custody structures, the wallet behaviors, these carry the fingerprints of institutional accumulation. The same pattern played out with Bitcoin before the spot ETF approval in January 2024. 18 months of quiet, deliberate accumulation. Then the approval dropped, and retail investors who waited for price confirmation, who needed it to feel safe, bought in 40%, 50%, 60% higher than the institutions who positioned ahead of the ruling. We are watching the same movie right now. Different asset, same script. Same institutional playbook. And the Clarity Act isn't the end of the setup. It's the confirmation that the setup was real. The institutions who were already accumulating just had their thesis validated by an act of Congress. Let me be direct with you about something, because I think you need to hear it. The retail investor trap is always the same pattern, and it plays out in every market cycle without exception. Wait for price confirmation. Wait for mainstream media coverage. Wait until every analyst on CNBC is bullish. Wait until it feels safe. By the time it feels safe, the move is 70%, 80%, sometimes 90% complete. The banks losing billions in market cap this week is not a warning sign for crypto. It is a confirmation signal. It means the power transfer, the one we've been tracking on this channel for months, is happening in real time. The legacy financial system is not fighting the disruption anymore. It is pricing it in. The question is not whether this shift is real. It is real. The legislation is passed. The ETF applications are live. The on-chain accumulation is documented. The institutional infrastructure is being built in plain sight. The only question, the only one that matters right now is, where are you in this? Here is the bottom line. The Clarity Act didn't just change the rules for crypto. It changed the rules for banking, for payments, for the entire infrastructure of global money movement. Banks know it. Their stock prices just told you. Institutions know it. Their ETF filings and on-chain accumulation just told you. And now you know it. The Clean 16 are not speculative bets. They are the assets the U.S. government just declared the legal foundation of the next financial system. The window to position like an institution before the retail crowd gets here does not stay open forever. This is the moment that separates the investors who understood what was happening from the ones who found out later. Don't be the person who finds out later. If this gave you clarity, leave a comment below and tell me, are you positioned? I read every single one. I'll see you in the next one.